How many years back should I backtest a strategy? Determining how many years back you should backtest a strategy is one of the most critical aspects of assessing the potential effectiveness of a trading strategy. The choice of time frame directly affects the quality of insights you'll gain about your strategy's robustness, adaptability, and sustainability. Selecting too short a period can limit your understanding of how the strategy performs under different market conditions, while using too long a period could incorporate outdated data that no longer reflects current market realities. To achieve meaningful results, you need to strike a balance between the period's length and the relevance of the data you're analyzing. The right backtest length will depend on a variety of factors, including market conditions, the type of strategy, the asset class, and the quality of the data. Let's explore these in depth. First, let's consider why the length of the backtest matters. Markets are inherently cyclical, going through phases such as expansion, contraction, recovery, and stagnation. These cycles can last several years, depending on the economy, industry, or asset class you're dealing with. Backtesting over too short of a period could prevent you from capturing the effects of these cycles, leading to an inaccurate assessment of the strategy's potential. Conversely, going too far back may introduce irrelevant data, as market dynamics, regulations, and even the structure of exchanges have evolved over time. For instance, the stock market has changed significantly over the past 2 decades due to factors like technological advances in algorithmic trading, the rise of high-frequency trading, HFT, and new regulatory measures such as the Dodd-Frank Act. A strategy that worked in the early 2000s might no longer be effective today due to these changes. Therefore, it's crucial to consider market evolution when choosing how far back to test a strategy. Market cycles are a critical consideration when backtesting. Typically, market cycles last about 7 to 10 years, but this can vary depending on the type of asset or industry. A good backtest should include at least one complete market cycle, preferably more, to ensure that the strategy is tested in both bullish and bearish environments. For example, if you're backtesting a stock market strategy, capturing data from periods like the 2008 financial crisis, the subsequent bull market from 2009 to 2020, and the market volatility during the COVID-19 pandemic would provide valuable insights into how the strategy performs under diverse conditions. In this case, backtesting over at least 10 to 15 years would be beneficial. The type of strategy you're testing will also influence how far back you should go. Short-term strategies, such as day trading or scalping, typically rely on short-term price movements and high trade frequency. These strategies are more sensitive to short-term volatility and therefore require less historical data. A backtest period of 1 to 3 years is usually sufficient for short-term strategies, as they focus on capturing small price movements and do not need to account for long-term market trends. For example, if you're testing a day trading strategy for the S&P 500, focusing on high-frequency trades that aim to exploit small intraday price fluctuations, a backtest over 2 years would be appropriate. The key here is to capture periods of varying volatility, such as the market turmoil of 2020 due to the COVID-19 pandemic, to ensure that your strategy can handle both calm and turbulent markets. On the other hand, long-term strategies, such as position trading, value investing, or buy-and-hold strategies, require more extensive backtesting. These strategies are less concerned with short-term market fluctuations and are more focused on secular trends, macroeconomic events, and multi-year price movements. A long-term strategy may require 5 to 15 years of data to assess how well it performs over time, including during economic recessions and booms. For example, a buy-and-hold strategy for blue-chip stocks like Apple or Microsoft would benefit from a 15-year backtest, covering multiple significant market events such as the 2008 financial crisis, the dot-com bubble burst, and the post-COVID recovery. This extended period allows you to analyze how the strategy holds up during different market cycles and under various external influences. Another important factor to consider is the market liquidity and volatility. Markets with low liquidity or high volatility require a longer backtest period to ensure you capture a wide range of conditions. For instance, the cryptocurrency market is known for its extreme volatility and rapid changes in liquidity. To fully understand how a strategy performs in this highly volatile environment, you should backtest over a period that includes both bull markets and bear markets, as well as periods of relatively low volatility. In this case, a backtest covering at least 5 to 7 years is ideal, with key periods such as the 2017 Bitcoin boom, the 2018 crash, and the 2021 bull market offering a comprehensive view of how the strategy reacts to these extremes. When backtesting, it's also vital to ensure the quality of the historical data. High-quality data is essential for accurate backtesting results. For example, if you are backtesting a stock market strategy, make sure that the data includes all relevant corporate actions, such as stock splits, dividends, and mergers. If these events are not accounted for, the backtest results can be misleading. A good example is Apple's stock split in 2020, which drastically changed the stock's price. Failing to adjust for such events can distort the performance of your strategy in the backtest. Another factor to account for is structural changes in the market. Markets evolve over time due to changes in technology, regulation, and economic policies. For instance, the rise of high-frequency trading in the mid-2000s fundamentally altered market behavior. Backtesting a strategy on data from before the advent of algorithmic trading may not provide useful insights into today's market conditions, where algorithms dominate trading volume. In such cases, it's important to test your strategy on data that reflects the modern market structure to ensure that it remains viable in the current environment. Thank you for watching.